TheoTrade. This is Don Kaufman. It's August 5th, 2019, and you are watching the TheoTrade evening video. There are literally seconds to go inside of today's trading session with the S&Ps closing down a staggering 3%. Also, what we term a statistically significant move, again, of 3%. Those of you that are aware, we are just a hair off of the 2842 gravity point. There's the closing bell. Let's get down to it and give you a little bit of analysis of not just what we're seeing on the screens effectively today, but what we could kind of anticipate in markets moving forward. Obviously, on this weekend's update, I gave you a bit of a feel for kind of what I was anticipating, and here we are. I mean, the first thing I think you really do have to ask yourself, are you feeling the fear? I think every trader looked at today's marketplace, and if you traded at all throughout the course of today's session, I mean, some of these sell-offs were just hideous, hitting lows, again, of 28.20 on the S&Ps. Again, seeing the S&Ps, I'll close this up for a second, down 110. The Dow was actually facing a 1,000-point loss at one portion of the session. Nevertheless, 3%, you kind of feel, if you're experienced in this business, getting out with a 3% loss is kind of getting out alive in today's trading. Let's break it down here. I actually built just a couple of points that I want to go over. First and foremost, S&P gravity points. If you don't know them, well, you're going to learn to love them because we are absolutely unequivocally adhering to those gravity points. The gravity points are levels. Those levels, we've actually been discussing them now for well over a period of a year. The levels are effectively 29.11, 28.42, 28.11, 27.31, 26.82, 26.26, and 25.75. Once we start to actually approach and hit these gravity points, we very well could be pinging between these gravity points a substantial amount in the days and weeks to come. So I'll reiterate, if you don't know the gravity points, you better learn to love them. All right. Do you think it's suspect that today's close is pretty much just off the 28.42? And frankly, we're not home yet. The marketplace has still got 13 minutes of trade left. Very likely that we're going to channel right in and around 28.42 into the futures effective close. Now, these gravity points, they are based, on very large trading firms create concentric areas of risk. We've been able to pick up on where those risks happen to lie, hence our gravity points. They're not per se support and resistance, but they are points that we are literally drawn to, very likely to see as stopping points along the way. Give you a couple of examples because I got to tell you, in terms of gravity points, take a quick look, This is actually last night. We actually cracked into the 29.11, channeled around it, In terms of breaking down on the marketplace, as the marketplace really started to break down, I'm going to go ahead and zoom out here, We stopped on a dime, at 28.42, sold off below it, came back to it. And again, it's effectively where we're ending up on the entire trading session after losing 29.11 to the next gravity point, 28.42, down below it. Again, we have 28.11. Now, moving forward on here, again, those gravity points, they're critical because on an intraday basis, you lose one gravity point or you gain a gravity point. Now you actually have a target to kind of shoot for. If you were to start to rally at some point this week, that 29.11, you should wear it like a target on your back. If we start to lose, and again, I'm just going to zoom back out for a second. If we start to lose the 28.42, clearly you've got 28.11. And below that, things just get hideous all the way down to 27.31. All right, onward and upward from there. Next, volatility futures and bonds. Now, a lot of people, they're going to be pointing to the VIX. The VIX, this is exactly what I was talking about in the weekend update. The VIX was taking a dirt nap, right? It was dead. Well, the beast has effectively come back to life here. And if you saw the volatility start to pick up, what a lot of people missed, this was nothing. The volatility future is really what came back to life. And this is where we actually get The topic for tonight, are you feeling the fear? Because the volatility futures are most definitely saying, oh yeah, we feel it, we see it. Take a look at the volatility and how inverted the volatility futures have effectively become. Now, the reason that I am getting into this is not for, hey, this was carnage inside of today's trading session. This is everything moving forward, right? You have a situation now where the 16-day vol futures, they're at 21.42. Going further out in time, 44 days out, we're all the way down to 20. The volatility futures are completely and utterly inverted right now. Even further out in time, the 72-day drop off to 1930. Okay, effectively what we're saying, there is substantial risk in the shorter duration, well above and beyond the risk of the longer duration. What does it say? We're in the throes of volatility now, plain and simple. To add to that, if you're not into volatility futures, not in the VIX, cruise down to the bottom of your screen. You'll actually look at the VVIX. That's the volatility of the volatility index. It is getting up there. But here, this still leaves something in my mind to be desired. I didn't feel capitulation today, and I don't think you did either. In fact, I'm going to revert back to the S&P futures for just one moment here. Look at this. They're actually sinking a little bit more. And I'm going to reiterate this. I didn't feel capitulation today. And I don't think that necessarily you did either. And we talk about things like capitulation, okay? What does capitulation look like? Well, one of the things you could throw out there is in terms of volume. All right, we were rocking today. We did almost 3 million contracts, okay? But in big, hideous kind of capitulation days, you should see that volume clear up to 3.5 million contracts in those S&P futures. We didn't get there today. Again, I don't want to stand here and say this is the bottom, this is the top, but I can tell you, okay, that volume should have been substantially more. Again, when it comes down to it, you say, are you feeling the fear? Well, sure. By looking at the volatility futures, they're inverted. No question about it. But looking at the VVIX, that coupled with the fact that the volume is just not necessarily there in the S&P futures, okay, this could be just the beginning. You, again, are kind of in this big catch-22. Now, the other aspect I want to bring to your attention is the bonds. People, the bonds have just gone hideous, parabolic. We just the other day we were talking about, wow, if these bonds get over 156, the proverbial crap is going to hit the fan. We're talking about the 160 handle, 161. Okay, take a look at the TNX, because if you look at the TNX over the last 9 months, the only thing you can call this right now is an outright crash. That is a crash, okay, of the 10-year interest rate to the downside of 1.735. Again, a 1.7 on the 10-year. Now, how does that compare historically? You go back 3 years. Well, there were lower rates all the way back. Again, 2016. Go back a little further. You even pull this up on a 5-year. Lowest rate that we've seen in recent history actually stems from, again, going all the way back into July of 2016 to see rates effectively lower than they are right now. All right. Moving forward, what you want to know about bonds is that the bonds have gone absolutely parabolic. All it's really telling us and confirming is duck and cover. That's all you really want to look at the bonds. So you have the volatility futures screaming, duck and cover. You've got the bonds screaming, duck and cover. But we ain't home yet in that VVIX. And again, it's bothersome. Okay, when you see a marketplace really capitulating, when you see a marketplace that's just downright going to flip around and rally back, you want to see this VVIX crack all the way to the 120, 130, okay? You have to feel that ultimate fear. You got to see volume spike. As I said, I'm not sure we're there yet. All right, onward and upward here. So we've covered a little bit about S&P gravity points, learned to love them. We talked about vol futures and the bonds. Delta in you, okay? Know your risk or die trying. Coming into any trading day, listen, you're going to be faced with some, hideous moves in the next 24 to 48 hours. How could I possibly know that? Well, there's an answer to that question. The answer therein lies in the SPX. First of all, the SPX in today's trade, it already cracked way outside of its expected move. The edge of the expected move was, again, we were anticipating as of this weekend, a $58 move. Well, tried for the corner and missed because we're already down $87. What's the SPX, though, proclaiming from this point forward? Like, how has risk changed? Because, again, this entire week we were looking for a $58 move. Now, we're clear up of another $85. From this point forward, you're looking at an $85 move, which, quite frankly, looks a little bit ironic given the fact that we've already moved 87 in one day. Know your delta risk. That is, go to your account statement, whatever your account statement may be, know what that delta is going to be. Okay? Listen, in this particular account, this is kind of a TheoTrade account. In these positions here, I'm not trading more than onesie, twosie stuff. Look at this. 3 lot of Bank of America and a 3 lot of Citi. Okay? What have I got? Maybe a 2 lot in terms of like Caterpillar. So your allocations need not be huge to crank out some decent profitability. Okay? You trade small, you stay small, and you better know your aggregated delta. Give you a quick example here. If I come down to risk profile, I'm actually going to bring up the thinkorswim risk profile. I'm going to go ahead and close up this left side bar. I'm going to beta weight into the spiders, and I'm going to aggregate my risk. Ready? What we're going to do is we're going to go from show all. We're going to hide all simulated trades. We're going to pull up every series. We're going to go from single symbol to portfolio beta weighted. Portfolio beta weighted is going to give me an aggregate of my entire risk of that portfolio at this moment in time. It looks like, based on this current spider level, I'm actually sitting on about short 1,500 SPY deltas. 1,500 SPY deltas. Now, here's kind of the cool part. If from this point forward, okay, whether we rally up or go down, check out the risk reward. If the market were to rally right now, a whopping 10%, I'm going to lose 22 grand. If the market were to sell off another 10%, I'm going to make 56 grand. That's always what I'm talking about. This ain't about direction. This is about knowing your directional risk. This is about knowing what your risk reward is at any given point in time. Know what your delta is moving forward, okay? Or you're, as I said, you're going to die trying. Don't go too deep, because the next, as I said, the next 24 to 48 hours, what is that really going to hold for you? Okay, well, there's an answer for that. You just look at the SPX. Look at the SPX between now and Wednesday. A $65 move. Now, a $65 move, that's the equivalent, if I go to the spiders, back over to the spiders, that's about a $6 plus move inside of the spiders. So if I'm taking 1,500 deltas of risk, and we were to see a $6 move, well, here's another interesting answer for this. I'm just going to go set slices $2 and $5 out of the money. Okay, this is what I'll look like if we rally up by $5. Okay, if we're rallied down $5, that's literally today. What would I look like by Wednesday? Just fast forward like 2 days. Okay, even if we go up another $5, I'm still going to be in very, very good shape by Wednesday if we go up $5. Today, okay, really helped. All right, Delta, know your risk, die trying. Moving onward and upward, the financials. All right, I know everybody's got eyes right now on the Nasdaq. The Nasdaq's effectively closing down what? Okay, to the tune of, again, 4%. Now, as I said, that's a statistically significant move. That's really what we started with. But 4% move, all right, you know, people are like, when are they going to turn the computers off? First of all, in overnight trade, if we go down and go down big, 5% is limit down. 5% overnight trade is limit down. During the trading session, they don't kick that in till 7%. So don't get ahead of yourself for a second. This is a nothing move. It's statistically significant, but it's nothing in terms, okay, of going limit down. Nobody's going to shut anything down. The Fed doesn't jump out from behind the curtain, say, surprise, okay? This marketplace is in trouble right now. You need to recognize that. Take a look at the XLF. The XLF, all right, I believe is absolutely pivotal inside of this trading. Okay, I talked about just a few days ago hitting 2650 on the XLF. The irony is I had no idea that it was actually going to hit 2650 within what? A handful of trading sessions. We were talking about possibility of weeks. We came crashing down to the 2650 hard and fast. And again, we're there. We're almost there in the after hours trade today. The problem with this 2650 level, okay, as I put up there, it's only the beginning. One of the kind of the demarcation line inside of the entire marketplace has been the financials. If the financials have been under this 2650 line, it's been hideously bearish for the entire marketplace. Above, okay, the 2650, it's been relatively bullish. Take a look no further than back at the chart and go actually put that against like the S&P chart, and you'll see precisely what I'm referring to. This, okay, at this point in time, it's only the beginning. We're not even under the 2650 level inside of the financials. And I know that everybody's got eyes, of course, on, look at the monsters of tech. Look what happened to Apple today. Yeah, look what happened to Apple. Go pull them up on a year-to-date basis. You realize that this stock is still up 22% in a year-to-date basis. I don't want to hear the words oversold. Can we bounce? Unequivocally, yes. Of course, nobody has a feel for wild volatility. But the last point that I want to make, okay, I call this channeling your inner bear. You better remember that stocks like Apple are still up 22% year to date. You better be mindful that the S&Ps, the spiders, are still up 13% on a year-to-date basis. Okay? And as you start to look down the list of some of the usual suspects, you can't find too many negative properties here. Take a look at like Facebook, which has been getting decimated the last, 2 weeks of trade. It's up 34% year to date. You can't start throwing out the terms like oversold. And this is not me trying to get you all bared up. Channel your own inner bear. Recognize how far we've come. And when you're done looking at a year-to-date chart, I suggest you pull up, 9-10 months. Then I suggest you should pull up a 3-year. After that, maybe you should even pull up a 5-year. Okay? Because this is how long it's been since we've had any degree of sell-side activity. Sure, we've had a couple of scares here and there, but when you start to look at the properties of something like a Google, you start to look at something like an Amazon, or you start to look at something like a Netflix, okay? Now, and only now, are you really going to start to feel the fear. Thanks, everybody, for joining us here at TheoTrade. Join us live tomorrow in the TheoTrade chat room at the Cash Open. It's going to be a wild week. Thanks, everybody. Have a wonderful evening. Bye-bye.